Nicholas Bornolis again of Capital Inc. I would like to welcome you to this panel. And I would like to repeat what I said earlier, that one of the great things that we have achieved during these 20 years we have been hosting this event is to develop friendships and partnerships with a number of institutions who join us year after year. And Fitch Ratings is one of them. Thank you for your partnership hosting this particular panel, the use of leverage every year. It's always a tremendously interesting topic, and thank you for being with us again. So I will turn over the floor to Peter, who's going to introduce our panelists. And again, thank you to all of you, each one of you, for being with us today. Very appreciated.
Well, thank you, Nicholas. It's our pleasure to be here as well. Even though it is still remote, as time goes on, hopefully this will be back in person again. So as Nicholas, started us off, today we're going to be talking about leverage use by closed-end funds. My name, obviously, is Peter Gargiulo. I'm a senior analyst in the funds and asset management team within Fitch. Our group assigns ratings to debt and preferred shares issued by closed-end funds regulated under the 40 Act, but also it can be applied outside of the 40 Act. And we'll get into that a little bit. And we also do some research in the space, and we've been doing this for panel, as Nicholas said, for multiple years. And it's, of course, my honor to do this for the first time, so glad to be here. Joining me today is an excellent panel, and I'll allow them to introduce themselves once I run through their names. Kim Green, my associate on the Funds and Asset Management team at Fitch, Mark Quaglia from TD Prime Services, and Nate Jones from Nuveen. Kim, why don't you start off, and then we'll go through the exact list of Mark and Nate. Introduce yourselves and give a brief description of your role.
Thanks, Peter. So yes, I'm Kim Green. I'm also an analyst at Fitch on the Funds and Asset Manager team, along with Peter. As he said, we assign and maintain ratings for closed-end funds and publish research on the sector. And I've been with the firm for about 2 years now.
Mark?
Hi, I'm Mark Quaglia. I work at TD Securities in the Prime Services Division. I run the fund finance business. I've been at TD for about 7 years, coming this December. And our focus is really on the taxable closed-end funds, as well as providing leverage to other asset managers.
Thank you, Mark. And Nate?
Afternoon. My name is Nate Jones. I manage the fund financing and the leverage management for our Nuveen closed-end fund. So, across, just under 60 funds, we utilize around 20 billion of leverage across, a number of different leverage vehicles. And, I work in kind of all facets of that management process, including working with our product development teams on, new structures and new products, as well as the ultimate sourcing and ongoing leverage management for these vehicles. Look forward to spending some time with you this afternoon.
Well, yes, and again, thank you all for joining us today. It's very helpful to have such market leaders to be able to opine on the sector and give some very good color to what Fitch kind of observes from our area as a service provider of ratings. So without further ado, a little bit different from years prior, we're actually going to start off the panel with a brief discussion of the closed-end fund criteria. I won't be asking Nate and Mark for their feelings on the changes that underwent in the latter half of 2020, because that could be a mixed bag for us. But I think it's important in the context of what's gone on most recently in the closed-end fund sector, and where Fitch kind of realigned itself in its criteria in terms of how we rate these leverage products. So anyway, without further ado, I'm going to let Kim take it from the head, and then I'll talk about some of the revisions that were made in 2020. So Kim, go ahead.
So here at Fitch, we have been rating closed-end fund leverage since the 90s with about 133 fund ratings as of May, which represents about 34 billion in outstanding debt and preferreds. So I can just give a little overview of our process and kind of how we use our criteria to get to ratings. So we look at the overall portfolio of a closed-end fund and look at each underlying security, whether it be equity, bonds, loans, etc., and we assess the liquidity of the security. We then apply discount factors or haircuts, which then give us discounted asset values, which essentially represent the amount of money we think you could get if you had to sell that asset today. Then we look at it at a higher portfolio level and take the total discounted assets and compare it to the amount of debt outstanding. And as you can see on this slide, we have different discount factors for the different rating levels. So higher ratings have higher discount factors. As you can see, the single A discount factor is higher than the triple B. So for a single A rated fund, the discounted assets have to be greater than the debt using the single A discount factors. So that's essentially how we get our ratings. And then I'll pass it back to Peter to talk a little bit more about the recent changes we had to the discount factors and the overall criteria.
Thank you, Kim. So, I think that to start off the discussion of some of the criteria changes that took place in December 2020, I think it's important to bring up a couple of key aspects that Fitch, we are aware, despite the moves that were made in criteria. Historically, from a creditor perspective, the closed-end fund sector has been a relatively strong asset class. As far as we are aware, there's never been a default on a closed-end fund on its debt or preferred shares, and certainly not since Fitch has been rating closed-end fund leverage. This is important to reiterate in light of those criteria changes. Just want to make sure from the top I'm saying that. So as you see on the slide, that this is a focus on the MLP and equity discount factors following the criteria revision. If you look under the AA column, there's no NC means no credit given, and essentially means that if you had a fund that was entirely comprised of equity and MLPs or just MLPs, the highest debt leverage rating you can come out to is a single A. Previously, you could attain ratings as high as AAA. Obviously, that required significant coverage, but after the criteria revision, those ratings are no longer attainable. Now, you could point to and say, well, this is a reaction to directly only to COVID, but I think it's important to provide some other context in light of the broader Fitch organization. And this has been an ongoing discussion for a while ahead of these criteria changes. And the change here, especially capping a lot of the portfolios or discount factors at a single A rating outcome, actually aligns the closed-end fund criteria more closely with other Fitch criterias that have significant market value exposure. And so, essentially that there's no AAA outcome possible for any closed-end fund leverage, despite the asset mix. And then AA rating outcomes, you can't see them on the slide, are only applicable to what we define as investment-grade munis. And then everything else, high-yield munis, the equities, as you see on the slide, corporate notes, and whatever the portfolio asset is, the highest rating outcome achievable is a single A now. And that single A, like I said, is relatively in line with other Fitch criteria with significant market value exposure. Now, obviously, the COVID-19 pandemic had an impact on a lot of closed-end fund portfolios, and we're going to get into that later in the presentation. But I think the MLP sector, as we're aware, with the COVID-19 pandemic, plus the concurrent oil market disruption, had a heavy impact of valuations there. And this is actually the one area where discount factors and Fitch's criteria had to be realigned to adjust for the 45-day worst loss, essentially the basis which these discount factors are founded upon. And like I said, all other discount factors didn't require a significant realignment, other than kind of shifting the paradigm in line with other Fitch rating criteria with market value exposure. So now that I went through that, and obviously there's a lot of material out there discussing this and that criteria change, which can be found on Fitch's website if you want to get some more information there. So I'm going to move on to slide 3. Having some issues here with the buttons. So in this slide, I'm actually going to hand it back over to Kim, and she's going to talk about closed-end fund leverage more broadly. And before we dive into the next 2 slides, which divides out leverage trends across taxable and muni closed-end funds. Kim, take it away.
Yeah, so this slide is looking at the overall leverage use in closed-end funds and the leverage ratio, so debt divided by assets. And these funds use leverage to boost income to their investors, although there are a couple of things that do limit the amount of use that they can use. So first is the 1940 Act, which regulates how much leverage funds can have. And in the chart, you can see the different limits that the 1940 Act has depending on the type of leverage. And then you have funds have their own documentation where they put their own limits on leverage, which could be different than the 1940 Act. And lastly, to the extent that the funds are rated by rating agencies also have their own limits around testing and asset coverage. So the chart itself, we looked at the top 150 closed-end funds and pulled their public financials to get their leverage ratios based on what they reported. Each dot represents its own fund. So you can see that taxable closed-end funds they are bunched around the high 20s, low 30s leverage ratio amount. And munis are a little bit higher with high 30s, low 40s, and just due to the more stable nature of munis themselves. And the different amount of leverage deployed just varies by fund manager and their own risk management practices. They have their own bands that they're comfortable maintaining their leverage around just to stay in line with their own practices.
Thank you, Kim. So now I'm finally going to get the external panelists involved. So my apologies for the long-winded criteria rating agency blurb at the front. But so Nate, at Nuveen, how do you manage the leverage of the funds you oversee?
Perfect. Well, I think we start with the asset class, and we really look into, where are we going to extract the benefit from leverage? And for most of our investment classes, it tends to be fixed income based, right? We're buying assets on the longer part of the yield curve and financing them on the short end. So, look at that aspect. Within that, the asset class segment is also kind of understanding the volatility of the asset class. So, how you might lever a muni strategy is very, very different than how you might manage or leverage an EM debt strategy or a senior loan class. Then I would look at that. Then lastly, I think you marry that up with what sort of financing options are available. And so, ultimately, you kind of marry those things together and, put around a framework, I would say that, is one that, manages not only the current needs, but also the potential volatility and the risk that go associated with leveraging, including renewal risk of leveraging strategies, but also the volatility of the asset class.
Thank you, Nate. And I'm going to actually do a quick spin on to Mark. So Mark, when you're looking at closed-end funds to provide leverage to, how do you underwrite or kind of assess the credit risk of those closed-end funds?
Thanks, Peter. I think to Nate's point, you start with the asset class, number one. I mean, if we're looking at equities, those are going to be viewed very differently than if we're looking at a portfolio that's maybe a high yield portfolio or senior loan portfolio. And then in addition, we're going to look at some of the portfolios now, given the focus on income distribution, where there's a building in of a lot of securitized products. So, what are the asset classes we're looking at, number one? What's the liquidity and volatility? And in addition, even though we're dealing with closed-end funds, what's that price transparency? As we get into some more esoteric investments, we can anticipate that sometimes there's stale pricing concerns and things that go on. And so while it's not a paramount concern per se, you do want to have that in your mind. And so, asset class is number one. And we try to obviously keep some diversity across that asset class and portfolio. So we'll look at issuer concentration. We'll look at sector concentration, right? It's specifically, we can see sectors over time getting hit. I mean, last March, March 2020 was a great example, right? Where we have, the COVID hit, and then we have the Russian-Saudi oil crisis. So I know a lot of MLP funds were really quite busy at that point in time. So we do want to try to be, even though closed-end funds tend to be thematic, we do want to, also be cognizant of which sector exposures we do have. And then within those sectors, sometimes, how granular do we get? Well, probably depends on that fund composition. And then again, lastly, the term. What are we looking at? Do we have, something that's rolling on a 179-day basis, or are we going out a little bit longer to try to lock in rates? I mean, obviously, we're in a period of low rates now. And so I think some managers strategically are trying to, create their leverage so that they have both short-term and long-term risks covered.
Thank you. And I guess in terms of strategically, aligning the leverage of a closed-end fund, maybe I'm going to actually rope in some regulation talk real quick, because we actually bring it up on the slide. How is the potential SEC changes to how closed-end fund leverage is calculated? How is that kind of impacting how you position the closed-end fund leverage on the Nuveen funds?
Perfect. I think you're probably alluding to the new SEC derivatives rule. I think for those that are a little bit more technical, 18F4. That was announced last year, and it's going to become effective in August of 2022. And while it has the name of kind of the derivatives rule, I think we really look at this as a leveraging exposure kind of rule. Obviously, it takes into account the impact that leverage or exposure a fund can generate from derivatives. But there is a very, a key factor that'll, I think, play itself out a little bit more next year, and that's with the impact of funds that utilize a significant amount of reverse repo. I know in taxable funds that tends to be very popular way of financing for some fixed income assets, but also on the municipal side, the use of tender option bonds or TOB floaters. Both of those are, obviously provide a backbone for leverage for a number of funds, but they aren't considered senior securities under the 40 Act. So as of right now, you have the ability to utilize them, and if they're properly covered, it does not count towards the asset coverage limits as currently drafted. Once the rule becomes into effect, advisors will have the option on a fund-by-fund basis to elect whether or not to treat reverse repos or TOBs as debt-like instruments, so it being incorporated into that 300% asset coverage limit, or to elect to treat them as derivatives and be subject to the various derivatives and VaR limits on that. What it means for funds is, I would say, those funds that tend to use a little bit more leverage, closer to 33.33% or higher, or it has a significant amount of capital, leverage capital sourced from that, may either be looking to alter those structures, and one way could be for those funds to issue, a little bit more preferred debt or preferred equity as part of the capital structure. One, to in essence kind of eliminate the treatment of repos or TOB floaters in terms of that calculation, or to provide additional headroom or coverage to the extent the fund elects to treat them as derivatives. So more to come in our place. I think we haven't probably seen this impact itself or being actually transacted just yet, but it's something I think certainly as we look into Q2, Q3 of next year, we'll start to see, I think, some of that market develop.
Thank you, Nate. And Mark, have you, it could be as simple as a no yet, but has there been any kind of discussions with some of the closed-end fund advisors that you provide leverage to regarding this derivatives change?
Yes, Peter. I would say that we've been talking to funds about it throughout the course of 2020 once it was announced, and I think it certainly varies where you go from fund sponsor to fund sponsor. Those that have been traditional users of repo, I still think are currently relying on it, and they're cognizant of it because there's no requirement to be compliant until August 22. So I think that there's a long glide path that they're viewing, and certainly given some of the favorable rates on repo, it is understandable that managers want to keep financing at those rates. But I think, as Nate said, that as we go through 2022, I'm sure people are going to start, crystallizing how they're going to address these things. At TD, we try to really, we service both the taxable and non-taxable funds, and we do it both on, let's say, the repo, TOBs, as well as the preferred shares. So what we've tried to do is kind of harmonize our products so that we have the solutions to really address the different structures that some of the fund managers are going to need to employ to help them take advantage of the rates at the time, and also kind of maintain the structural leverage that they need as we move forward.
Very interesting. It'll definitely give us something more to talk about next year. I think as this all comes to play, if this conference is at the same time, we'll see the shakeout of that pretty quickly. So let me actually get ahead to the next. Yeah, I'm going to head to the next slide. And this is actually a good segue, considering, we were just talking about, the usage of reverse repo. This slide, essentially there's a historical look back 15 years, strictly taxable closed-end fund leverage, and, how much leverage was outstanding at any given reporting period, the mix of that leverage. And obviously you can see some trends that begin to play themselves out here. I think first and foremost, you can see the market cyclicality has a significant impact in terms of how closed-end fund leverage ratios, how high they are, how much is outstanding at any given time. 2008, 2009, I don't need to I guess, beat that dead horse anymore, but, clearly that was a big moment for the market and had far-reaching impacts for taxable closed-end funds and how much leverage they have outstanding. Probably the next period that you could see a dip in closed-end fund leverage is that 2014 to 2016 timeframe. Clearly the stress in the energy market, directly impacted MLPs. Fortunately, that was only a part of the market, but clearly, still had a significant enough impact where you saw leverage numbers drop there again. And I'm not going to get into 2020, 2021. Kim's going to go into that a bit more detail in a minute. But I would also just kind of notice that beyond just, market cycles or market externalities, you see there's other things in play here. In terms of market innovation, you see in the second half of 2008, in conjunction with the global financial crisis, you see ARPs kind of falling out of favor, or losing their desirability insofar as that they're not making up a large mix of the outstanding closed-end fund leverage, and you see that steadily diminish over time until it's a trace amount in terms of the overall exposure for any given reporting period. And then I think in terms of maybe the discussion we just have regarding derivatives, this is again a market externality. Yes, it's on the regulatory side, but where you're going to see something that is external of how advisors manage their closed-end funds that they have to respond to, and it's going to change the closed-end fund leverage environment, let's say. So I kind of briefly mentioned it before, but Kim, could you just give a brief overview of some of the data in this chart and specifically speak about what we saw in early 2020 and coming out of that?
Yeah. So in the beginning of 2020, there was a lot of stress in the market due to the COVID stress in March. And we saw a lot of funds having to delever to maintain their asset coverage. And we even saw MLPs become forced sellers. There was deleveraging across all asset classes. And we also saw funds liquidate or completely delever. And the decrease in leverage was driven by bank financing and repo, which managers tend to delever first, just due to the fact that it's a little quicker to get done, and in times of stress, they go there first. Since the first half of 2020, we've seen leverage slowly start recovering year over year, and that's being driven by repo and bank financing as well, just kind of due to the similar reasons I said before. And then as of now, in the first half of 2021, the most common leverage we see in taxable closed-end funds are bank financing and repo, which is then followed by public preferreds and private preferreds.
Thank you, Kim. So I guess with that context, and focusing on the right-hand side of the chart, with the pandemic and coming out of the pandemic, or recovering from the pandemic, let's put it that way. Nate, can you speak to the response in early 2020, and then kind of how you're managing your closed-end fund leverage now?
Sure. So obviously some flashbacks of some of the pain of 2020, but I think when we're going through that process, and especially as we look back on it now, I think one of the keys that come out of it is communication, and that communication is set up well in advance of any sort of, I would say, market stress. The communications that we have with our financing partners on the banking side, the communications that we have within product with our investment teams, as well as other outside or third kind of party folks like the rating agencies or advisors. So when all of that kind of comes to a head, I think that the thing that we take away from 2020 was how volatile and how fast everything happened, right? So this wasn't a fixed income focused event. This wasn't just purely equities. It was everything all at the same time. And so when we get back to that communication aspect of it, the ability to, have to deleverage, understanding exactly where your pain and threshold and covenant standpoints are absolutely critical. And as Kim had mentioned, you look at what can be done and what can be done quickly, right? Obviously, the collapsing of repo and credit facilities, no surprise that was, probably the first aspect that a number of advisors had looked to deleverage. Whereas preferred, given the notice requirements that are done, the fact that it tends to be a little bit more cumbersome to add leverage back, ultimately are usually left for kind of, I would say, the cleaning up process or anything like that. I think equally as important though, and I think some of your other what you'll see in kind of the recovery aspect of it is, while deleveraging was required in some of these asset cases and some of these funds in order to stay within compliance of 40 Act limits and lender limits, the recovery also required kind of, I would say, a keen insight as to where leverage ratios are, where new assets can be purchased and financed, so that the recovery isn't completely lost as you're under levered kind of in that appreciating environment. I think it's been kind of interesting over the last 18 months. We have been essentially in a rising valuation market, both in kind of fixed income and equity standpoint. So I would say the memory, though, of 2020 is very keen in, I would say, shaping product, but also lenders and advisors' mindset, especially as we move forward here.
Yeah, it was definitely amazing to see the functionality of closed-end funds to actually delever and kind of the amalgamation of regulation and ratings and advisors themselves with their providers to successfully delever in an orderly fashion. I mean, again, I said it before, but no one kind of missed a payment or was excessively breaching. Everyone successfully delevered, and there was no, it was. I mean, given everything going on, it was very orderly. And I'll turn to Mark. Mark, can you kind of speak to, and actually being on the front end of it, considering where TD stands in the space, your interaction during that time, definitely being a key component of the success of closed-end funds to delever during those stressful times.
Sure. So, I think it's been an interesting change from 2014, 2015, where there was a rush to put on long-term preferred shares for, in anticipation of rising rates. And then, specifically a lot of funds at that point in time got caught offside a bit, especially MLP funds who locked in some preferred shares due to that dislocation and lots of breakage fees. So I think, number one, as Nate mentioned, as we found ourselves in 2020, you're always going to hit the repo and the credit lines first to delever as necessary. And I also think that, a lot of funds out there had less on the preferred shares, especially long dated ones, given the lessons of 2014, 2015. Communication was key, whether it was on our muni funds or the taxable funds. Again, the taxable are cross assets, so we certainly had our hands fun, whether it was looking at the loans, the high yield bonds, or the equities, and obviously the munis too. And that was really the number one thing, right? Like making sure that we're in communication with our fund managers. I think a lot of them were proactive and certainly stepping down leverage and not really getting themselves caught offside. But we partner with folks that we're looking to grow a business with, grow a relationship with. And so I think having that communication leading into it, and then being in daily communication throughout it, that gives our folks internally, our risk managers, a lot of comfort that we know what's happening on their side, we know the thought process, and so it assuages any concern that things are going to get worse, right? That we're partnering to make sure it gets better. And then similarly, with such a fast recovery, can you be there now to make sure that they have the ability to hit that target leverage ratio that they're looking to get back up to, right? I mean, certainly spreads blew out from a funding perspective for a lot of banks. And I think, some, funds maybe had a challenging time acquiring financing, especially if they were caught in a renewal process. And so I think, that's what helps in partnering with a bank with, kind of a stable balance sheet and things of that nature that's maybe not doing everything off so that you can, ensure yourself that you can weather the storms and kind of partner as recovery happens, because, that's a key moment to maybe get things at a depressed price where you see some upside.
Definitely. And I guess I'm going to add one more wrinkle in here. Obviously, there's definitely some changes on the horizon for taxable closed-end fund leverage, especially given the derivative discussion we already had. But Nate, are you seeing any kind of new developments in terms of types of products on the taxable closed-end fund leverage side?
Yeah, so I mean, obviously, I think the development on the preferred side will be the big thing for going forward. But what we've seen thus far is, I would say, probably more capital structures that have multiple types of leverage forms, right? So marrying the reverse repos with credit facilities, focusing on asset segments. A number of strategies that have come out have been kind of a little bit more go anywhere, multi-asset. That's ones where there'll be pockets of ability to finance segments of that at much cheaper levels with much, I would say, longer term structures than, an asset class or a fund that has a singular kind of focus on strategy. So I would say that's probably one of the things that we've already seen occur, and probably will likely continue to see that move forward in 2022 here.
And I guess from Mark, from your side, I mean, we kind of already referenced some of the taxable closed-end fund leverage products that you offer, but can you speak to exactly, what TD offers or participate in terms of taxable closed-end fund leverage, and has it been relatively dynamic coming out of the pandemic?
I would say that, well, first of all, what we're trying to do at TD is really provide leverage across the capital structure, whether it's senior debt, senior secured notes, or the preferreds. We have the ability. We have a growing prime brokerage business, and so rehypothecation is certainly always an option, just as repo is, and we want to be there for that short-term financing to help our clients take advantage of it. But we're also very active in the credit facilities and then the preferreds as well. So we will buy those and take those on balance sheet on a kind of a strategic basis. And same thing on our muni side. We're participants. We do the TOB structures, we do VRDPs, we do VMTPs, and so it's really ensuring that we can be there because we know that the needs are changing, and so we need to kind of we can't just be focused on the long term or just short term financing, but we do need to have the tools to be able to participate because when someone's in Nate's shoes and they're looking at their leverage structure, they need to be able to harmonize between products. And so if we can do that from a one institution perspective, I think then we're offering the client the value of being able to get, one team focused on their leverage structure.
Definitely. And you brought up muni, so you gave me a good segue to the next slide. So perfect.
Well, no problem. That was the cue.
All right. So next slide here. Same idea here, but focusing on municipal closed-end funds. Again, 15-year look back, but obviously very different in terms of kind of the cyclicality and how these leverage ratios have kind of moved over time. Clearly, still global financial crisis, 2008, 2009, you still saw a drop, obviously not as severe as that you saw on the taxable side, but then you see some pretty relative stability over time. I mean, there was some notable increases in 2013, coming out of 2016, and then obviously we had into the COVID pandemic and another slight dip, but I'm not going to talk about that too much. Kim is actually going to bring that up in a minute. So, definitely, again, that the kind of theme of stability in terms of municipal closed-end fund leverage has always been kind of an ongoing thing over time. And obviously, again, you have the same kind of market innovation that comes into play here, right? So I think 2 years ago when Greg was presenting this, MFPs were the big discussion point, the formation of them and how the transition and refinancing in MFPs was kind of the going theme of municipal closed-end funds. And you still see the MFPs being utilized in the capital stacks of municipal closed-end funds today. So with that, Kim, what are we seeing in terms of municipal closed-end fund leverage more recently coming out of the COVID pandemic and into 2021?
Yeah, so as Peter just said, municipal closed-end funds are more stable than the taxable closed-end funds. And this is just due to the more stable nature of municipal bonds in general. We did see some deleveraging in the first half of 2020. And this was kind of driven by TOBs and bank financing, kind of similar to the taxable, where bank financing drove the deleveraging in the space. And we can see the leverage is starting to slightly go up as well. And that as of first half of 2021, VRDPs, VFMTPs, and TOBs continue to be primary sources of leverage. And as Peter said, we still see MFPs having a stable share of the leverage that municipal closed-end funds have.
Thank you. Yeah, so, similar kind of questions to the taxable. Obviously, there's a lot of these things are different in terms of when you're managing a closed-end fund. But I mean, Nate, is there any kind of a difference when you're how you manage closed-end fund leverage for municipal funds versus taxable?
Yeah, I mean, I think we alluded to this during kind of the deleveraging in 2020. There are a number of steps that are required to actually redeem preferred stock as opposed to paying down a revolving credit facility or collapsing repos. So you tend not to get those smaller movements. They tend to be larger movements if you're going to be conducting them. That's why I think when we went through the stress in 2020, you saw managers collapse TOBs there as opposed to redeeming preferred stock. But I think one thing that's kind of interesting with your slide here and kind of maybe highlights this is that, when you look back, with the ARPS crisis or with the ARPS period, you had option rates and you had TOBs. But as you move further on the right-hand part of the image there, just a number of different, boxes or a number of different types of structures, right? And where I think the evolution on this preferred within the muni segment has really kind of taken off is that, well, these are preferreds that are kind of designed for certain asset segments or certain kind of leverage capital segments, right? So you talked about the VRDP, that's being one that's been primarily sold to money fund or short duration investors that require liquidity from a bank as a backstop. But when we look at the VMTPs, the MFDs and those segments, those were held and purchased directly by banks or other institutional investors. And the innovation, I would say, in that different types has largely been, well, once you have the preferred, what are ways to refinance it or to keep the leverage outstanding, but be able to pivot into different types of structures. And so I think we'll still continue to see some of that moving ahead with the muni funds, but certainly a different kind of a wrinkle or element than we're kind of accustomed to on the taxable side.
Thank you. So I don't want to beat up on Mark too much. I know you focus on the taxable side, but I guess what was kind of the much, if it might be largely similar, but during the COVID pandemic, was it a lot of the bank financing movement? How is TD been kind of looking at muni closed-end funds in terms of the kinds of leverage that they take out?
Well, you're right. I mean, my focus is really on the taxable side. My colleague runs the non-taxable side. However, we work pretty closely together. I would say that really our view on municipal leverage is somewhat the same on taxable, right? We're looking at what type of assets are in there, IG versus non-IG. What type of municipalities are we dealing with? Healthcare, schools, and making sure that we have adequate diversity, right? I mean, and that's kind of the hallmark of that, to ensure you just have that portfolio construction to present any type of kind of protection against a hiccup in a particular sector. So I think that's number one. Two, I think your chart's pretty illustrative of what we're seeing as far as the muni market goes. And as I mentioned, we are kind of involved across those products. Going back to the crisis, again, communication was key. I know that, certainly we're the 6th largest bank in North America. So again, strong balance sheet, AA-, really, really helpful in these times. So it allowed us to, certainly gain some market share at that particular point, from certain managers that needed funding. But it allowed us to also be stable, dealing with the BRDPs and things like that. There's certainly some stressors, but staying in communication with our clients allowed us to have an understanding where things were going and how they were managing through that, so that we could kind of, be comfortable with, where's the inflection point and do we need to be concerned? So I think, again, they somewhat mirror each other, obviously different asset classes, but the approaches are similar. And as you look forward, innovation, I think to Nate's point, you think about what's the structure of the financing, and every bank has its regulations, right? And certainly some are country specific, but I think making sure that we can accommodate what the fund needs when you're going out. Is it something really short dated? Is it a liquidity provider, so there's a backstop, or do we need to do something a little bit longer term? And how do we get creative in doing that, so that we're accommodating what we need to do internally as well?
Excellent. And I guess Nate, have you seen any kind of along the same lines of innovation? Have you kind of heard anything on the street in terms of new innovation types, given the stability of the municipal closed-end fund sector, as it's shown over time? Have there been other kind of thoughts around, other types of leverage that these types of closed-end funds could utilize in the future?
No, I think, sorry, Nate.
No, please, go ahead.
Yeah. Oh, no, I was gonna defer to you on that one.
Yeah, I'd largely say it's also taking into account environment and where yields are, right? So given the compression where we are on short yields, obviously it opens up less of a discrepancy between, what would traditionally be a taxable type financing credit facility or repo versus in a more normalized state where you want to be able to pass along that tax exemption benefit that the underlying assets are earning. So that mix between debt and preferred is there. But I would also say, I think when you look at a lot of these strategies and pretty much most of these closed-end fund strategies, leverage tends to be a perpetual part of the overall framework or plan of the fund, whereas a lot of these instruments, even the preferreds, have shorter tenors. And the way you can enhance, or I would say, improve structure is largely around being able to facilitate that, short to long aspect, whether it be more convenient or cheaper, frictional costs in terms of renewing and refinancing. I think is where you'll see kind of continued evolution with this.
Definitely, and I think with even the VRDPs are a significant portion of the capital stack. I think we've kind of talked about the taxable side, kind of the derivative changes that are going to be occurring in August 2022. There is also another big question mark out there: money market fund reform. What does that kind of mean for prime, and where does that shake out? I think there's still some headwinds out there that are kind of outside the scope of a closed-end fund advisor, even a closed-end fund leverage provider. I think coming up in the next few years, who knows? That no one's kind of really determined when the foot is going to fall, let's say. But I think there's definitely more opportunities for advisors and providers to get creative and think about how to, like you said, perpetually maintain those leverage ratios, either with a new product or utilizing an existing product in a different way.
Yeah, certainly. I think that's we'll see more and more. So.
Yeah. It definitely is not boring out there. Let's put it that way. But I think maybe everyone could use a break for a couple of years.
I'm sorry to interrupt, but we are 1 minute past our time. So if we can.
All right. Well, so I'm sorry about that, Nicholas. I actually lost track.
No worries.
The last slide was just to talk about the devaluation and recovery, but obviously it's pretty apparent based on kind of the discussions, and if anybody's been involved in closed-end funds, they know how the market has recovered. Again, thank you, Nate, Mark, for your time. It's been really great having you. Kim, great job. And again, we appreciate the opportunity to do this, and I will cede the floor, or the Zoom, I should say.
Well, thank you to everybody. Thank you, Peter, for the great moderation, and thank you to all the panelists. It has been a great panel. Thank you very, very much. And next year, we will do it hopefully in person. So thank you again. Thank you.
Thank you.
Thank you.
Thank you all again.